Major support for these broadcasts is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's window company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, All Nation Renovation, Ackman Ziff Real Estate Group, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Giantomasi, Goldman Properties, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Corming Communities, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Site Comply, Sterling & Sterling, Stonehenge Partners, Triangle Equities, The Wickoff Group, Urban American.
So are we here at this happy days are here again? As I start my 11th season of the Stoller Report, I have 4 dynamic, intelligent individuals who know the capital markets and the investment market. And they think that the world is looking great. So I really want their opinions and to provide their insight. So my guests today include Peter Habsburg, who is the chairman and CEO of Eastern Consolidated, Aaron Youngrice, who's the president of Rosewood Realty. From Baltimore, Spencer Levy, who is the Executive Managing Director at C.B. Richard Ellis Capital Markets. And last but not least, my friend, who I call the statistician, the co-founder and chairman of Massey Knackle Realty, Robert Knackle. So statistician, no statistics, Nate.
You want adjectives?
I want adjectives. How's the market? How's the market, Bobby?
Well, value is holding up very well, and certainly the volume of sales is increasing very significantly, has increased very significantly from 2009, but we're starting to see a little bit of an abatement in the volume, both in a dollar volume of sales perspective and the number of buildings being sold. We believe that the statistics for the third quarter will be below what we saw in the second quarter of this year. There are a number of factors affecting that, but I think that lenders are being a little bit more cautious and investors are being more cautious.
Did you tell the guy who considers you like the dean of investment brokers, Mr. Youngrice? He said before that the world is great. Come on,
well,
Aaron.
He keeps making deals every day.
Come on, Aaron. You know, you're selling properties like it's potatoes over here in cupcakes.
That's true. That's because I don't go to the Hamptons like these guys do on Thursday.
No. Peter is in Westchester, if I remember right.
Pound Ridge. At Friday, I leave at 5. I come home 5 minutes before Shabbos, and I'm working.
But wait a second.
And I'm working Sundays. So
That's
I got
exactly
lucky
a
this
bunch of lazy
summer.
bums.
These guys don't realize that the market still is great. I'm just,
So how is the market? I mean, you're very optimistic. Is it the best in your, what are you, 41?
41.
So you've been in this business a long enough time.
Right. I think it is better than it was 4 months ago.
Do you think it was better than in 2007?
Yes. I'm sorry.
Wouldn't you say this is the most remarkably short recovery from 2009 in terms of a market recovery than we've ever seen?
Yeah, absolutely. And I think, Aaron, to your point, I think that what we've seen within the brokerage industry is that the brokers who are doing a lot of business are doing more business, but the number of brokers that are very, very active has shrunk. And that's what happens anytime you go through a downturn. It's a weeding out process. We saw the same thing in the early 90s. with the S&L crisis, and to some degree the same thing in the early 2000s during that recession. So I think, we're all very, very busy. We're all doing more transactions today than we were doing a year ago or 2 years ago. But the fact is that the market in total, we are seeing a very tangible reduction in the number of transactions over the past few months.
And what do you see on a national scale?
Well, things are good on a national basis for certain types of deals. Major markets, core, basically stabilized transactions. The market is still good to very good, notwithstanding the fact we have seen a big pullback in the debt capital markets. The markets that have been most...
Debt capital markets, we're talking about the CMBS market, the collateralized mortgage debt.
That's a big piece of it. And certainly the CMBS market most affected the secondary markets the most, because really in the primary markets, the New Yorks, the DCs, the San Franciscos, the CMBS players were not that big this time because the life companies were really providing, and some of the big banks were providing a lot of the capital there. It's the secondary market trades where the CMBS markets were more important, is where we're seeing more problems because of what's happening today. But I would still suggest that even in these secondary markets, if you have a stabilized transaction, you still have a very dynamic bidding interest in those transactions. It's those transactions that are not stabilized in these secondary markets that have borne the brunt of some of the
Now,
pullback.
an interesting situation. The prior show, we were talking about who's coming to America, who's buying, where the interest is. And prior to the show, Peter was bringing up the fact that certain land development sites, which we hadn't seen, are reaching higher numbers than we've seen
In 2006 or 7.
So what do you attribute this to?
New York City, for one. I mean, I'm glad to hear it's healthy in as many cities as you just mentioned, but it's almost like a flight to quality or treasuries for a lot of these foreigners. They want to be in Manhattan or New York City in general.
But since you have two roles, I mean, many roles, but you're involved with M&T, when you see a transaction on loan committee, how are you evaluating these things?
Well, the guys who are getting the loans, the construction loans for condos today, are brand name super guys with 50 to 60% loan to value. If you were a first timer now with a 100,000-foot site, you probably have a tough time getting financing for a new condo.
And what about a foreigner? I mean, a foreign investor. I'm not talking a foreigner.
Foreign investors typically in development deals pair up with some local name anyway. They're just the capital.
Yeah, and Michael, I think it's important also, we talked about the volume, but value, and as Peter's mentioning with the development sites, value is holding on very well and in fact increasing in a lot of areas for a couple of reasons. One, we're in an interest rate environment that's extraordinarily low. And the 10-year the other day dipped below 188 for the first time in history.
182.
And that is keeping lending rates down significantly, particularly for the portfolio lenders that are the most active here in New York City. We're seeing tremendous demand from foreign buyers, from local buyers, and we're in a supply-constrained environment. And notwithstanding that the activity has been very, very strong, if you annualize what occurred in the first half of this year, turnover for 2011 will still be only 2% of the total stock as opposed to a 25-year average of 2.6%. So we're not even near what the average has been over a long term. And I'm sorry about the statistics.
No, I was going to say,
I think it was 2.5.
I really was going to think, that this is Major League Baseball and Fantasy Sports Network combined over here with the numbers over here.
Yeah.
Thank you, 2%. Tell me, let's talk Talkless. How many buildings have been selling? Well, tell me what's happening. Where's prices today on multifamily residential?
It matters where. It matters.
Brooklyn.
Where in Brooklyn? If you're in Crown Heights, it's all multiple base because the cap rates, they're all up below 5 when you really do the real
Okay, so
numbers.
it's multiple. But how much higher can these rents go? Okay, I mean,
In Brooklyn, they can because a lot of people from Manhattan are moving to Brooklyn. And a lot of the buyers who I was selling to in Manhattan are now going to Brooklyn because it's really the same type of housing stock. It's the same, tenants, sipping coffee with the knapsacks, going on their bikes. It's those funky type of tenants who they're going for. And in Manhattan, they have to pay.
Now, what about, where the tennis courts are and the baseball stadium, Queens, or any multifamily buildings being sold out there?
Absolutely.
Yeah, Michael, one of the byproducts of this
We really
downturn,
do a lot. I'm sorry. We do a lot of Queens, Massey and Rosewood. We do a lot of Queens, I'll tell you.
Yeah, one of the byproducts of this slowdown in the market in this recession is that new construction has been at relatively low levels. So that is going to create supply constraint in the market. Rents in Manhattan have been escalating, and that creates a natural spillover into the outer boroughs.
And what happens if we have a double dip? What happens if we have a recession, like Joe Ficalora said on my show the week before? You know, what's going to happen? What do you see?
Well, what's already happening, and multi-housing is the one area that is certainly the preferred asset class for institutional investors. We've already seen some pullback in the underwriting assumptions for rent growth. I think we've consistently seen rent growth assumptions in excess of 10% all over the country for well-positioned multi-housing deals. We've seen that already pull back to some degree. Now, it's still at elevated levels. They're still predicting rent growth at the 6-7% level, which is extraordinary by historic standards. So we will see more pullback like that, not just in multi-housing, but also in some of the other asset types. The issue with the other asset types today, with the exception of certain submarkets, is you're not seeing the same amount of objective rent growth that you're actually seeing in multi-housing. Because you can actually point to many markets, and I'm sure New York is no exception, where you can actually see 10% type rent spikes happening today.
But here's a question, and I pose this. You know, August came around. Maybe, you know, like Aaron was saying, many people were on their vacations and they weren't around. But you know, there was you know, the ratings by S&P. The stock market went up and down. Crazy situations happened, and many tenants, many office tenants who were thinking of renting space, unless they really had an immediate need, called their brokers up and said, you know what, I'm waiting. I'm not rushing to move today. And sitting down the other day with a number of honorable, leasing brokers, I said, tell me the truth. They said, yeah, it's slower. Mm-hmm. You know, it's slowed down. People are, you know, I'm not that interested in 2 years down from the pike. You know, I'll stay with what I have right now. So, and Scott Reckler was saying, you know, he had been looking at some buildings recently, and they've dropped down in the office pricing.
Well, Michael, there's a lot of uncertainty in the market. If you
that's exactly what I'm saying.
Look at all economic indicators, they're all trending downward. And I think the likelihood of a double-dip recession is probably greater than 50-50. And if you think about it, if GDP growth is less than 1%, even though that's technically not a recession, that's still a recession. But you have to look, the market responds to recessions differently. During the recession in the early 2000s, the volume of sales dropped to its lowest level in 25 years, but yet value was unchanged. Unlike the recession in the early 90s, value
dropped.
If
we hit a recession, I'm really posing this question, you know, because we were talking a little bit about land values and other things. If we hit a recession, do you think people will still pay $600 for a development site?
We're in a recession right now. As far as I'm concerned, just Manhattan and Brooklyn happen to be different markets. But you know, the reason they're paying these kind of numbers is because there's so little coming online in 3 years that most guys figure that if they have the new product in 3 years, they are going to get far greater than the comp show today.
And what's happening in Westchester? You live up there, you know the...
Westchester's always been thin trading. It never really went up high in 06 and 07 and never really went down low. There's very little office demand, though, so the office guys up there are sort of sucking wind. And there's very little multifamily.
And what about the Connecticut, the Greenwich market, and that, which I heard is also down. I mean, it's not, you know, not all the hedge funds need as much square footage and everything.
In terms of office rents,
right? Office.
Yeah,
rents.
office rents are down. But I'll side with Aaron and say we have yet to see a decrease in values in New York City.
And what about retail?
Retail has been strong. I know Bob mentioned before you thought you saw rent dips on 2nd and 3rd Avenue.
Well, our retail leasing brokers are saying they're seeing some softening in rents along the fringes, but yet Madison Avenue, West Broadway, 5th Avenue rents are up, and the value of retail properties is going up
Cap
very
rates are still, you know, as low as they can possibly be.
Some of these retail tenants are doing particularly well. I mean, you really, if you segment retail, you look at the so-called high street retail tenants, their sales per square foot are extraordinary, not just here in Manhattan, but also around the country in many of the particularly high-end retailers, and that's supporting values. And we've seen cap rates not only hang in there, but they're actually getting lower.
I mean, you know, in October, Uniqlo is opening up their largest store ever in America, the largest store in the country, in the world, an 89,000 square foot store at 666 Fifth Avenue, and a week later they're opening up a 62,000 square foot store on 34th Street. So they're very positive, you know, fast retailing. And then, you know, about 2 months later, Zara is taking over the corner over there. So retail is doing well, urban retail and high-end retail. I'm not certain about the retail in the suburbs. Okay, how do you have you had retail sales in the boroughs? I mean,
I had
of
4 in the last 6 weeks.
what type of properties?
One was Willentis's piece. Willentis bought from Shia Boimel in Dumbo. He was obviously the ultimate buyer. We just did 2 retail deals in Brooklyn on Flatbush Avenue. Long-time owner, we sold it to a local Syrian family. The cap rates were about 6.5.
What kind of tenancy? That's more.
On the Dumbo deal, it was a Chase, a dark Chase, New York Post Office, a parking lot, a vet, and a mom and pop, and the Flatbush Avenue with mom and pop.
What
Where
do
do you see the rents going? Up, down, or holding?
Holding, not going up.
Right.
That's true.
That's the situation. They're not going up over there. I mean, first of all, the 5 boroughs, even the Bronx, is under retailed. So we have an under retailed situation in different cases.
Correct.
So it's a different situation. How do you see? I mean, you're in Baltimore, Washington. You know, and they're 2 different markets. Baltimore is different than Washington. In Washington, you know, we got the government. You know, they're spending their jobs. How is the Baltimore market?
Well, the Baltimore market is good with certain segments of the market. Multi-housing, very strong. Well-positioned retail, also very strong, and also industrial. Office is a little choppier because office.
I still remember when Strivey was going to build over there, and Bank of Scotland had a major commitment over in Baltimore.
But
It's only a couple years ago that the world was great in Baltimore.
Well, there are some segments of the Baltimore market in office which are doing very well. The East Harbor, which is a brand new development, is doing very nicely. But there is, in Baltimore, like a lot of the older post-industrial cities, have corridors that have a tremendous stock of Class B properties that have weak tenancy. So Baltimore is not unique in that sense. If you take a look at a lot of cities with a similar profile to Baltimore, a lot of them are in the Midwest.
I'm going to take a little closer. I was writing this article. It really was an article. It's a 1010 Winds report about office buildings for sale. I even spoke about your property that you're selling on 46th Street in the Diamond District. And then I said, and now we go to Newark, New Jersey, where Verizon is selling their building, and they're hoping to get $41 a foot, and they're going to lease back 50% of the space. And, you know, look at, you know, Newark has seen some revival, but you can buy a building for $50 a foot. I mean, you just said to me land costs $700 a foot, $400 to $700 a foot.
Power of Manhattan.
So you're saying the suburbs are having a different world?
Yeah, as a matter of fact, I'll ask Spencer a question here. I had a meeting with an investor yesterday who was had been shopping for a $30 million office loan in New Orleans. And, well, he was working with his CMBS banker who quoted him cost of funds plus 150, and then 2 days later it was 180, and a couple of days later it was 220, and then 280, and finally our guy said, "That's it, don't call me anymore." He did it with a regional bank at 200 over.
Right.
Is that affecting the secondary markets?
Well,
turmoil.
It certainly is, and the spreads on CMBS have blown out much higher than that. Even, I mean, we're seeing spreads as high as 375 or higher. Pricing all in the six and a quarter kind of range. So yes, it is affecting pricing in the secondary markets. But as I suggested earlier, the major markets were not affected by it because the CMBS really wasn't a player this time yet.
No, but you know, I'll give you a situation. I have a friend who has a major hotel, and he's looking to refinance and maybe recapitalize the situation. And he started this position 4 months ago. And 4 months ago, he had all the CMBS boys talking to him about deals. And today he has the insurance companies and the banks. The CMBS are not, I mean, a 5-year loan from a bank, if it's a good property, you can buy with a swap at 4.25%, 4.5%. CMBS 5 years, 6.5%.
Yeah.
So they're out of the business. The conduit business isn't there.
But there is a big queue which is coming to market now. In the next month or so, we expect it could be as much as $5 or $6 billion that's attempted to be taken to market. If that prices well, if the investors show real interest there, and I think that they could, if we see a little bit of stability in the global capital markets, I would not be surprised to see the CMBS market come back at the end of the fourth quarter, early first quarter.
But I think, you know, with what Bob was saying, and Peter, if we take everything into consideration, and also Aaron's comment, look, where are you putting your money? If a treasury bill is only going to give you, if a 10-year treasury bill is going to give you between 180 and 2%, you know, and money market, you'll get 0.25%. Wouldn't you rather own a piece of an apartment house?
You know,
maybe
it's funny you mentioned that. We had the first conversation I've had was we have a seller with a $30 million closing coming up on a Brooklyn building, and He had no mortgage on it. He was an old timer, and he postponed the closing. And we said, why? And he said, I don't know what to do with the money, because at the time the Treasury market was crazy. The stock market was going up and down like this. And he called his accountant, and his accountant said, you want to keep it in real estate. So it'll close, but it's the first time I've heard anything like that come out of somebody's mouth.
That's the big situation. Where are you going to put it?
Yeah.
I mean, you look at the market up and down, and that's why, even if you look at it, people are interested in the dividend stocks, like the Con Ed, or like some of the banks, like New York Community, which is paying like a 6%, or the Dime of Williamsburg, or something like that. Even GE at $15 has a good stock. So, your choice of opportunities are less.
And Michael, that's why we're seeing a lot of foreign interest. If you look at the economic turmoil in Europe today, and certainly a couple of those countries are going to default, and I wouldn't be surprised to see an EU that is vastly different a year from now than it is today. Anyone who has high net worth in those countries has to look at the United States
There is no question,
or investment.
A wealthy Greek family or a wealthy French family or a German family is going to take their money out if they can and bring it in here. I mean, I wrote about it. The largest investor last year to the U.S. was Canada, followed by Israel, and the world has changed because the Israeli investors of 10 years ago, of 15 years ago, that we remember, they were the entrepreneur who wanted to buy a thing. Now it's Migdal Insurance, Menorah Insurance. They're the institutions who are Harel, Galileo, who are working together with the local people, like you said before, and the same situation with regard to the hospitality and the rest. I mean, Gary Barnett's deal on 57th Street. You have the Abu Dhabis and all the rest. Do you see Do you see the Middle East investors?
Well, Middle East investors, we see a lot of Chinese investors, Korean, South American investors when we have deals in the southeastern United States. So a tremendous amount of capital, and a lot of it has to do with notwithstanding some of the issues we see in Washington, there's still great relative political stability here. The property rights are unquestioned, and the cost of the dollar, certainly as it relates to Canada, is, we're on sale.
Canada is definitely on sale, and that's why the Canadian investors really, with the difference in dollar, used to be 20%, now it's negligible.
Remarkable change. Yeah.
I mean, it's a totally. So where do you see 2012?
It's hard to see how pricing can get any stronger than it is now, or cap rates any lower. But then again, and the one thing I think could affect it is certainly a change in interest rates or a rise. But if you listen to our political leaders, they fully intend to keep them at these levels for the next 3 years. So,
and how do you see your buyers when they're buying a building? Are they taking, because the banks aren't taking the futures. Banks are taking actual cash flow today. They're not saying, I'm going to get another $10 a square foot. Sure. Are they locking in, or are they taking floating rate, or are they taking fixed rate?
They're locking in, and they also are willing to put up more cash because they think the dollar, you're not getting anything in the bank, as we said before. So if they're not putting in 40% cash, they'll put in 30%. It's still better than putting in 20, 25% cash and leaving more of the debt service to allow what's going to happen with the property.
Bobby?
Yeah, but one of the things that's a concern, Michael, is that our low interest rate environment is really, it's indicative of two things: failed monetary and failed fiscal policy. Okay, and what low interest rates do is they create asset bubbles. You could make a great argument that today the stock market is overpriced because of this easy money that we've had. And there's a concern that is, if interest rates stay this low for this long, does that mean that investment properties are in a bubble condition?
You know what? Someone said to me, some of the funds are sitting there and saying, I have the money. I don't think that my exit cap is going to be enough in a couple of years. I really don't know, because that's the long term. We know what it is today, but we don't know where it's going to be in 5 years. And to make the money, and the assumption isn't there.
But Michael, one of the things that's interesting, and I think certainly Aaron and Peter would agree, Spencer, I don't know, your investors are probably more institutional in nature, but the vast majority of the people that we work with don't use terminal cap rates and probably don't know what an IRR is. But they're very, very successful looking at basic cash flow.
I have to tell this quick story. Many years ago, I met the legendary K.B. Weissman. Now, K.B. Weissman was like the dean of hard money lenders. And KB, I said, how do you evaluate? I go and look how many rooms there are in a building. And that's how I lend, based on the number of apartments, based on the rooms. Don't tell me what the rent roll. I know what the neighborhood, and it's like the back of the envelope.
It's the gut feel.
It's the gut feel. And, the gut feel sometimes is the right thing.
Yeah, back in the 19s.
But, when we were looking, at the end of 2007, 2008, when people paid $450 for the site on 40th Street, which was sold at a different number. Quick question. Where do you see investment note sales these days? One bank called me up, literally one of the largest banks calling me up for an advice. He says, we don't have much things around. He wanted me to say, what's happening with the other banks? I said, they don't have that much around either.
No, the banks were very proactive, and through most of 2010, the banks were unloading a lot of notes.
So there's not that much
now. No, but now the note sales are coming out of the special servicers, and we're seeing that process.
Yeah, it's
very
still a
slow.
strong market, and the pricing has been very strong as well. We've done a lot of par plus sales of notes because investors.
So you're still seeing a note business
Oh yeah,
this year
very much
Absolutely.
so.
from the special services.
Several very large deals in the market. $10 billion deal from an Irish bank. There was a couple $1 billion deals that are in market right now. So there's a
Right,
lot
those are the large special service deals, and you're going to probably see more because of the deals that can't make sense in next year based on the numbers that they were underwritten a couple years ago.
And Michael, the loans that were made in 06 and 07 that were floating over LIBOR, as those loans mature, which maturity is really precipitating those note sales because even though there were significant negative equity positions, there was still positive cash flow
But you
on
know
those
what?
properties.
What you're really saying is true. Look, if somebody bought a building or something and they did it on LIBOR floating, that's how they can pay their rent. That's how they can pay their debt service.
LIBOR plus 300 will make any deal work.
That's right.
Until the mortgage matures.
Until the mortgage matures. So I'd like to thank all of you for providing some insight on the state of the investment market. Looking very positive from all outlooks. I'd like to thank Peter Habsburg, Aaron Youngrice, Spencer Levy, and the statistician Robert Knackel. See you next week.
Major support for these broadcasts is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, All Nation Renovation, Ackman Ziff Real Estate Group, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Goldman Properties, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Corming Communities, Madison Realty Capital, Massey Knackel Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Site Comply, Sterling & Sterling, Stonehenge Partners, Triangle Equities, The Wyckoff Group, Urban American.